All right, let's jump straight into this explainer. You know, we spend our entire working lives absolutely obsessing over optimizing our 401ks and pensions, right? But we tend to completely overlook one of the biggest retirement windfalls out there, selling your actual house. Today, we're unpacking a really specific IRS provision. It's called the Section 121 exclusion, and it can dramatically reduce or, honestly, completely wipe out taxes on massive home sale profits. This is a rule that literally rewrites the math on your retirement.
Picture this. You're finally ready to downsize, or maybe you're packing up to move closer to the grandkids. Your home's value has absolutely skyrocketed over the last few decades, which, hey, looks fantastic on paper. But for a lot of retirees, that excitement just evaporates and panic sets in. You start wondering, wait a minute, is the IRS going to swoop in and take a massive 20% slice of all those lifelong gains? And honestly, just the fear of that holds so many people back from ever selling.
And this isn't some rare one-in-a-million scenario either. Let's say you bought a totally modest house back in the 80s or 90s for around $100,000. Well, after decades of inflation and crazy market demand, it is incredibly common today to see that exact same property pushing $1 million. What started as just a standard place to live has silently grown into this mountain of wealth.
So, in that scenario, you are sitting on an $800,000 profit, which sounds like an absolute dream for your net worth, right? But in the real world, realizing a gain that massive usually comes with a huge, terrifying catch. When you finally grasp just how much profit you're actually holding onto, your mind instantly goes to the tax consequences of cashing it out.
This is exactly where people just freeze up. They sit down with their financial advisors, they run the capital gains calculators, and realize they could owe hundreds of thousands of dollars. It creates this totally paralyzing golden handcuff situation. People literally stall their retirement plans, staying trapped in these giant, high-maintenance houses they don't even need, entirely just to avoid a six-figure tax hit.
But here is the absolute game changer. Built right into the current tax code is a provision meant for this exact situation, the capital gains tax exclusion, or Section 121. Think of it like a giant financial shield. It effectively blocks a massive chunk of your home's appreciation from being taxed at all. It just totally cuts through all that anxiety and gives you a clear, tax-free path forward. Here's how the math works. If you're a single filer, the IRS literally lets you lop up to $250,000 straight off your profit before they even start counting your taxable gains. Just think about that for a second. The first $250,000 of pure profit goes straight into your bank account, completely untouched by capital gains taxes. And if you're married and filing jointly, oh man, it gets even better. That exemption doubles. You can exclude up to a cool $500,000 in tax-free gains. That is $500,000 of your life's investment completely preserved, giving you the actual liquid cash you need for your retirement.
Now, obviously, the IRS doesn't just hand out $500,000 tax breaks to every single person flipping real estate. You actually have to prove this was truly your home. So you're probably wondering, what's the catch? How do you actually qualify for this?
Well, it boils down to what tax pros call the 2-in-5 rule. First up, ownership. Your name has to be on the deed for at least 2 of the last 5 years. Second, residency. You must have physically lived there for 2 years. And third, it has to be your primary, everyday residence. Not a weekend getaway, not a side gig, your actual main home.
Where people usually trip up here is trying to get clever with secondary properties. If you try to claim this massive exclusion on your summer beach house, or an investment rental you use for passive income, yeah, the IRS is going to say no. The same goes for sloppy paperwork or missing deadlines. It being your primary residence is absolutely the key to the whole shebang.
Okay, enough abstract rules. Let's actually bring this down to earth and run some real numbers. Imagine a retired couple sitting down at the kitchen table to plan their finances right after dropping a sold sign in their front yard. Let's see exactly how Section 121 transforms their whole life. So they bought their house decades ago for $150,000 and they just sold it for $650,000. Boom, that's a $500,000 profit. Normally, massive tax alarms going off everywhere, but they apply their joint $500,000 Section 121 exclusion. The result? $0 in taxable gains. They walk away with every single penny of that $500,000 profit completely legally.
And why are we talking about this right now? Because with home prices doing what they've been doing lately, just absolutely skyrocketing across the board, knowing this rule is more crucial than ever. It takes off those golden handcuffs. You can downsize, you can move near your family, or you can just cash out without being held hostage by the fear of taxes.
Now, a quick reality check.
Everyone's financial landscape is a little bit different. Ownership histories vary, maybe you have a weird special circumstance, and tax laws do shift over time. When you're dealing with hundreds of thousands of dollars, you absolutely must sit down with a qualified tax pro to build a solid plan for your specific situation.
Because at the end of the day, knowledge like this can literally save you hundreds of thousands of dollars. It completely flips the script from dread to an incredible opportunity. So as you look around your own house and start planning that next chapter, you got to ask yourself, are you going to let the fear of phantom taxes hold you back? Or are you going to use this rule to finally secure your financial freedom?